Hello, everybody. Uh, this is Paul doing a very quick little check-in to give you a quick update on how my week has been going so far, different moves that I made, and just different opinions on the market. Um, so first thing I wanted to go over is I'm recording this at 2:40 Central Time on a Thursday. So the market is still open so that you can kind of see what my portfolio is doing today and how it's been going. As you can see, I'm having a pretty good day. My portfolio is up 0.4%. The market's up 0.8%. Um, and there's some single stock names driving this right now. If like Morgan Stanley and whatnot, just different ones that reported very good earnings. So wanted to do a quick little update. Um, so last time that I checked in, I had um, placed money into AWF, and I had spoken about different things to do with the Fed and how I wanted to shift my portfolio more into the market this year, at least until I saw interest rates rise or the Fed make some type of move that would greatly affect the markets. So right now I'm at 57.43. I have pulled my municipal funds. I pulled money out of OP Tax, GYI. I pulled about 1,000, maybe close to 2,000 out of each. So now I'm more in the market now. Um, so the money was moved into LTC, and my last video was on the 9th, but as you can see on the 13th, I've been putting money here and there. So on the 13th, 1 share, 6 shares, 4 shares, 5 shares, 10 shares today. And also I put money into SPHD. Today I bought 10 shares. And then also you'll see a new addition named KRE. KRE is the regional bank tracker. And the reason why I went with KRE over XLF is I believe that XLF is currently I wouldn't say overvalued, but well valued. Um, a lot of, I would consider it kind of a hold. I wouldn't consider it a buy. So KRE, the reason why I went into KRE right now is because you can see that the market is currently looking for things that are good earnings, good dividends, safe plays with low price to earnings. And if you go into KRE, this is a regional bank tracking ETF. So this is a lot of the banks that are around pretty much everybody who's watching this video. And if you look at it, it's at a 12 PE. You might recognize some of the banks in here. Some of these might be local banks to you. Regions is a very big one in my local area. But it's just local banks with solid earnings. So Regions, for example, is at 11 PE by itself. And the reason why I didn't buy Regions specifically, the stock itself, even though I could have, is I find, as I covered in the last video, I find it easier just to buy through ETFs, especially if I plan on holding for long periods of time. So I bought, let me show you what I bought here. So I bought just 10 shares, which put me at 573. I'm already up almost 1%. The regional banks start to report throughout this week because all the banks report first. So wanted to just kind of jump in on that. I thought now would be a good time to jump in on that since I see everybody searching for value. And so I jumped in on that. AWF is one stock that I was up, and I haven't updated my sheet yet because I'm still in the current trading day. But AWF is up here. This is the corporate bond. I pulled money out of AWF because I was at 100 shares. And the reason why I pulled money out specifically is because we're past the ex-dividend date. So I will still get paid the dividend for this stock, or this right here, AWF. So I'll still get paid the dividend for that on the 17th, which is tomorrow, or actually, yeah. So, and I'll probably jump back into that before February 2nd, but I wanted to move money out of there and put it to work somewhere else. So where I put it to work at recently is the ex-dividend date on LTC is 122. And as I explained in my last video, I like to get into, if I see a dividend stock that's at a good value, that hasn't been crowded, because currently O seems pretty crowded to me. At 59, the dividend is safe, but it's just richly valued. And if I can buy something that's less expensive with the same quality, I'm going to jump into that. So what I did is I jumped into LTC more here, and as you can see, I've been making some pretty sizable gains as everybody else has been jumping into just these different REITs. REITs period have been performing very, very well. SREIT, for example, I've been in SREIT forever, well, I've been in and out of SREIT, but SREIT's been performing very well. This is a global super dividend REIT ETF. It just tracks global REITs. LTC's been performing beautifully, up 3.84% since I started adding more to it. And I'll stay in LTC. I don't see myself moving out of that one. If I did, I would maybe pull. No, I don't see myself moving out of that one. I'll have to decide if it depends if the market drops or something like that. SPHD, I did put some money into it. This is a low volatility, high dividend. I don't expect this one to normally move too much in stock price. That's kind of the entire point of it. It's low volatility. So I'm not trying to trade the spread, which means that, I'll buy it low and then sell it high or something like that. So I'll end up holding on SPHD. And then we have Maine. Maine's about the payout. So the ex-dividend date is the 21st, and then the payout's on the 14th. So when I jumped out of the municipal bonds, so what I wanted to go over was long-term versus short-term taxable gains. And this is actually going to be pretty important for anybody. If you notice, a lot of people, I'm not sure how a lot of platforms are set up, but with E-Trade specifically, they don't release your 1099, which is the form that you have to file if you get dividends, until the middle of February. So what that form tells you is it tells you specifically what's taxable, what's non-taxable, in terms of if what the government can tax you for, basically, when it comes to dividends and if you sold stock or whatnot. It tells them how to categorize your different things. So what I wanted to show you is there's a gains and losses page here. If I go out to taxable, so this is me selling, so this is OP tax right here. You can see I made $117 when I sold that. You see how it says long next to it? So if I go over to, this is a simple, thecollegeinvestor.com, and there's, if you just Google search short-term taxable gain rates, make sure it's for 2020 specifically, because the first result that pops up on Google is using old prices. It was in 79,000, and this goes up with core inflation. This gets updated every year. So right now, since I held the stock for longer than a year, it is a long-term capital gain. And I'm married, so be filing probably this way. and then between 0 to 80,000. So the tax rate on that long-term capital gain on this is 0. Now, if you see the short term, so you see I sold AWF today. You can see I sold quite a bit of AWF today to redistribute it into LTC and SPHD. See, it says short, and then it says 21. So if you go to short, and then you look at wherever your tax bracket is. So if I was here, for example, I'd be at a 35. And as you can see, it jumps significant once you pass 80,000. If you look at this right here, so see how it jumps from 12 to 22. So you have to watch your tax brackets because you could be significantly affected depending on how. If you're above $80,000 a year, just hold long term. If once I get above $80,000 a year, I could easily see myself just go on the straight dividend growth investor thing, like that path that you see people do. A majority of the YouTube videos that talk about dividend growth investing that are really, really informative, I could very, very easily see myself doing that. But 12% hit, so, and then so just so you can kind of see what's going on here. The thing that really matters on this page right now is this thing that says short. So let me go back on over here. If you want to know how my performance has been doing, so I am up 1.44%. If I take the S&P, Dow Jones, I'm not going to take the NASDAQ. I guess I could take the NASDAQ, and you can just see how crazy the NASDAQ's been doing. But as I described in my last video, my goal is not to take the dips. So as you can see, as the markets do these wild swings, I kind of catch the middle, just ride the wave up. So when the markets do correct, and I promise you they will correct, I'll go over that here in a second where I expect it to correct that. You can kind of see I'm just kind of riding a wave, staying right there with the market, not taking any dips, just going straight up. And that's where I like to be. My estimated income right now from dividends, 1144 within the next month at roughly 90. Since I did pick up KRE, I actually do have spikes now. As you can see, it spikes up every third month or so. So 1144 or 11 or 1000. So yesterday, this went up by about 70. So my previous video, I believe this was at 24 or 25,025. So I haven't contributed an extra dime to this portfolio this week. 25 minus 25,307. So $282 in just flat out capital gains. And then so what's kind of interesting is as I was selling the municipal bonds, this actually dropped down to 550 because this is capital gains. These two numbers right here, and each day has just been pretty ridiculous on because so many people have been piling into the REITs that they've just shot up in a pretty remarkable way. I showed you the NASDAQ 100 was at 3.6. This is already up 3.85. Here's 3.65 right here. Here's a 522. You know, I got it on the 31st. If you look at that, since the 26th, if you've been going heavily into, well, probably LTC or any of these, you've been riding pretty high right now. Especially this one right here. This one's just been pretty remarkable. Just a ride up. Energy stocks did something very similar. If I go back to MLPX, they did something very, very similar. Since the end of November, they're up 12%. just remarkable run up in prices, which typically tells me that it's going to pull back. And the reason why I know it's going to pull back is because normally everybody tries to pile into LTC and O and any of these other REITs right before they pay or right before their ex-dividend dates. And if you can kind of look at their chart, you can kind of see what happens. So there's the ex-dividend date, and then the dividend pays out, and it kind of, so as soon as that, so like I stated before, as soon as you hit the ex-dividend date, as long as you're in before the ex-dividend date, the money is settled, you're in. If you sell after that, you're on the list to get the dividend basically at whatever you were in there at. You can sell out. People recommend you never do that because when a dividend pays out, that's money that's paid out from the price itself. So the fund itself normally tends to go down by as much money got pulled out to get paid out to the shareholders. In this case, for example, like so LTC is a 1.8 billion right here. And if they pay out their dividend, it goes down by as much as it paid out. So that's how the stock price gets moved around. The way that people have been playing this lately is they ride the share price up, for example. So you see how it's up 81? Even when the dividend gets paid out, and let's say this drops back down to 46, for example, this would go down to 60. So there's still a $60 gain that you could potentially make, and this only works in stocks that are like LTC, for example, that are going up at a rate higher than what they pay out. So when it pays out, it's going to go down, but you're still going to have a difference in capital gains. So a lot of people pile into LTC right before the ex-dividend date. As soon as that ex-dividend date hits, they normally start to trickle out of the fund and go to different things. So for example, so as you see, you can be in here by the 22nd, get your dividend on the 31st, pull out, and if you're a big fan of O, well, if you are in O by the 31st, you get paid on the 14th. And there are people that rotate between these two. They just literally will rotate between here, down to there, here, down to there. And it's perfectly legal. It's not recommended unless, it's not recommended at all. But if you want to, if you're this kind of person that wants to do that, if you're trying to figure out what's going on, why they're moving around so much and why they're just not steady, that's what people do. They pile in. As soon as they qualify for the dividend, they pile out. USFR does this all the time. Just a lot of funds do this. And that's why I mentioned before previously with Disney, they pay out twice a year. So you'll see a lot of people pile in right before their dividend date. Or right before their ex-dividend date. So that's why it's good to keep these in mind. And then also, so as you can see, the market has had a pretty great run. So I like to follow this guy. If you've ever followed this guy on Twitter, he's pretty funny. He posts some pretty funny stuff. He's kind of a bear because he's looking at the market as a guy who's probably been doing this for 40 or 50 years at this point, and the market just does not make any sense for him. So he's seeing just different things. So for example, what he's seeing is the market shoots up, and then the market just trades sideways. And then the market shoots up, and then the market just trades sideways. This is a $1 trillion market that's doing that. So what he's seeing is, basically what he's seeing is Federal Reserve repo purchases, liquidity injections, making its way into the market. It's impossible to kind of deny that this is not happening. So even the Fed, Robert Kaplan, has said that this is happening. More federal people are going to say this. So what he has noticed is that a pattern is setting up where the market could be setting up for a drop. Because and the best way to explain this is the market trades or has a line that trades its value. And the market itself likes to follow that line, and the line basically tracks the earnings of the market. I don't have that in front of me right now, but it's basically the actual earnings of the market, like where the market actually is. Well, the market is way up here right now where you see it. So what happens is the market normally likes to correct back down to that line, wherever the earnings, the actual earnings of the market actually are. So whenever it gets kind of runaway high like this, it tends to do that, to correct down to the wherever the market is pricing in where the earnings could be. And if you look at any chart or pretty much anybody who's been in the market for a very, very long time, they're all kind of sounding red flags. And I'm starting to get on board because this market, so for example, this 3,300 that you see right here, according to the best case scenarios from multiple banks where they have a very large amount of people that get paid a lot of money to figure this out, this was not supposed to happen until the end of December of this year. We're 16 days into the month, into the year. We've already hit targets that were not supposed to be hit until the end of the year. In the best case scenario, and that's with earnings at 10%, everybody beating earnings by 10%. So what a lot of people are expecting is that as soon as the Federal Reserve says we're done with repo, we're done injecting money, we think everything's good, a lot of people expect this to do a very sharp drop down to where earnings actually are. So it's everybody's kind of piled in right now is what they're saying, but you can kind of see how the market wants to it wants to correct back down. And if you look at where it corrected down to previously, it corrected all the way down to here. So it could be in for a drop, and that could be, but it depends on what the Federal Reserve does, which is why you have to watch the Federal Reserve. If you're concerned about if you're the kind of person that times the market, if you're the kind of person who just says whatever, I just care about my dividends, then you're just going to get whipsawed around. But the problem is with the dividend strategy, if your dividends pay out, say right now at 46.72, let's just give this an example. If my dividends paid out right now at 46.72, okay, $10. I think that's what this is at right now. This is paying out. And this corrected all the way back to 39, and I have 48 shares. You could do the math. 46 minus 39, $7 difference. 7 times 48 shares. That's $336. So I just bought, or the dividend reinvestment just bought this stock at 46.72, and I just lost, I got $10, but I just lost $336. So that is why you see a lot of people trying to time this market. And once the Fed indicates that they're done and the liquidity starts to dry up, it will drop. It's going to drop back to, it always does. It always drops back to that line that tracks where the earnings are supposed to be. Like where the market fundamentals tell you where it's supposed to be. And this one could be set up for a pretty big drop. And if you notice, they happen quick. You don't have much time once it starts to drop. And when it drops like a stone. So, and the reason why that matters, and I'll probably get some dislikes for this. So, there was a video I was watching where a guy said if you invested just $1 in 1900, by today that $1 would be worth $625. Pretty impressive return. What the guy said, and this is a guy that he specializes in this, and he does it far more than I ever will. But he tries to time the market. He looks for signals on when to pull out, when to get in, that kind of thing. And what he said is if you had put that same $1 in, but time the market whenever it dropped, whenever it hit a bottom or whenever it hit a top you sold, that $1 would be worth about, I think the number he came up with was 1 quadrillion or some obscene number. You know, so that's why people will try and time the market. That's just why they do it. Um, so just to let you know what could be happening here pretty soon. If I see it coming, I will pull out. Like so, for example, if I see a large drop coming and I know it's going to happen, and I can kind of see it happening, and I'm before the ex-dividend date on LTC, I will pull 1 grand out of LTC very quickly because I will lock in that profit right there that you see. This profit right here, these profits outside of my municipal, because these municipal bonds don't move no matter what, really. But I'll lock in these profits so that the next time you see my video, it will be higher than 25,300. Because, you know, if you ever see those kind of drops, the people that like to post videos, they'll give you a video with a higher number, but the higher number is because they actually put money into it, not because they're showing you how much it dropped. Or else they would actually post videos with the numbers going backwards. So, just giving you a kind of a general idea of my thinking, where I see the market at right now, where I see it going. And so let me know if you have any questions, just about kind of anything you see going on here, anything you disagree with. Just feel free to leave a comment. I'll be happy to go over it, tell you where I'm coming from, why I kind of do the things that I do, and just my market philosophy. But I do thank you for listening, and you have a very nice day.